President Trump frequently speaks about the trade deficit. He often blames China and other trading partners, sometimes accusing them of stealing from the United States by creating this deficit. But is this really correct? Does a trade deficit actually mean that other countries are stealing from America? Is a trade deficit necessarily harmful? And more importantly, what truly causes it? Let us begin with the basics. A trade deficit simply means that a country imports more goods and services than it exports. In economic terms, this implies that domestic spending exceeds domestic production. Part of what residents consume is produced abroad. Now, the key question becomes, how is this excess spending financed? If a country spends more than it produces, the difference must be financed by foreign capital. In practical terms, this means foreign investors must send capital into the country. They may buy financial assets, invest in businesses, purchase government bonds, or lend money. Those inflows provide the funds that allow domestic residents to spend beyond national production. In the balance of payments, this means a trade deficit is typically accompanied by a capital surplus. The inflow of capital is the mirror image of the trade deficit, but this immediately raises a deeper question. Which comes first? Does demand for imports create capital inflows? Or do capital inflows enable excess spending, and therefore larger trade deficits? In economics, causality is rarely simple. Relationships between variables often run in both directions. Effects are indirect and mediated by other factors. Some economists argue that a trade deficit leads to a capital surplus. Their reasoning is straightforward. If citizens demand foreign goods, electronics, automobiles, manufactured inputs, they send their currency abroad. Foreign exporters accumulate that currency. Since they cannot easily spend it domestically, they reinvest it in the importing country's assets, for example by purchasing government bonds. At first glance, this explanation seems logical. However, by itself, it cannot explain a sustained long-term trade deficit. Consider countries like Egypt or Argentina. If they run persistent trade deficits, why would foreigners continuously want to accumulate large quantities of assets denominated in Egyptian pounds or Argentine pesos? These currencies are not global reserve assets. Their financial markets are smaller and perceived as riskier. If the trade deficit causes capital inflow story were sufficient, then any country importing more than it exports should automatically attract stable, long-term capital inflows. In reality, many countries that run persistent trade deficits eventually face currency depreciation, rising interest rates, or balance of payments crises. Investors lose confidence. The currency that leaves the country is exchanged into other currencies, rather than recycled into domestic assets. This suggests that causality often runs in the opposite direction. Sustained capital inflows are what permit sustained trade deficits. But that still leaves the fundamental question unanswered. Why does capital continuously flow into the United States? There are several structural reasons. First, the US dollar became the world's primary reserve currency after the Bretton Woods Agreement in 1944. Because global trade and financial transactions are largely denominated in dollars, investors prefer holding US assets. Second, the United States has one of the largest and strongest economies in the world. It has many large companies, diverse industries, and countless opportunities for business and investment. Another important reason is stability. The US has clear laws, strong financial institutions, and transparent markets, which helps protect investors. Finally, the depth and liquidity of US financial markets. This means investors can easily buy and sell any quantity of stocks, bonds, and other assets with minimal friction. For these reasons, the United States remains one of the most attractive destinations for global capital. So, excess spending in the US is financed by foreign capital inflows. But the spending itself is carried out primarily by domestic actors, households, corporations, and importantly, the government. Since the mid-1960s, structural government spending increased significantly. Beginning in the early 1970s, the federal government started running fiscal deficits in most years, spending more than it collected in taxes. This timing matters. It occurred just before the United States began running persistent trade deficits in the 1970s. It is also important to understand the context that preceded these trade deficits. During the 1960s, the United States was far wealthier than many of its major trade partners. In 1971, when the US began running a trade deficit with Germany, it was roughly twice as wealthy. Similarly, when the US began running a trade deficit with Japan in the mid-1960s, it was nearly 4 times as wealthy. The US economy was already highly service-oriented, with more than 60% of the workforce in services. It had a sophisticated financial system providing easy access to credit, mortgages, consumer loans, credit cards, allowing households and the government to spend beyond immediate income. And above all, it possessed what became known as the exorbitant privilege, the global demand for dollars as the reserve and trade currency. By contrast, Germany and Japan were still catching up. They were poorer. A larger share of their populations worked in factories or agriculture. Their financial systems were conservative. Credit was limited. Consumers had to save for years before making major purchases. These structural differences encouraged high savings abroad and higher consumption in the United States. In simple terms, Americans were more willing to consume. Other countries were more willing to save and invest. The United States consumed more. The rest of the world financed that consumption. From this perspective, the trade deficit was shaped largely by U.S. policy choices, persistent fiscal deficits, accommodative monetary and credit policies, and the institutionalization of the dollar as the world's reserve currency. Now we must ask, is a trade deficit bad? Most economists argue that a trade deficit by itself is neither inherently good nor bad. Fast-growing economies often run trade deficits because they attract foreign capital to finance investment and expansion. Conversely, running a trade surplus does not automatically signal strength. Countries experiencing weak domestic demand may run surpluses simply because they import very little. Japan, for example, has recorded trade surpluses during periods of economic stagnation. Historically, the United States ran trade surpluses before the 1970s and could potentially do so again in the future. What most economists agree on is that trade disruption is harmful. Free trade increases consumer purchasing power by lowering prices. When households spend less on basic goods, they have more income available for other goods and services, supporting broader economic activity. Importing goods that other countries produce more cheaply allows a country to allocate its resources more efficiently. Instead of using labor and capital in low-value, labor-intensive industries, those resources can shift in the medium and long term toward higher-value sectors such as technology, advanced manufacturing, and services. This is the principle of comparative advantage, which states that countries should specialize in what they produce most efficiently. Protecting low-value industries such as toys or textiles in a high-income economy would tie up labor and capital in lower productivity activities, raising costs and reducing competitiveness in higher-value sectors. This would slow innovation and growth. Additionally, many developed economies already face labor shortages in low-skill manufacturing. Workers are not necessarily eager to return to labor-intensive factory jobs. Therefore, running a goods trade deficit is not automatically a sign of weakness. It can reflect a process of specialization that allows an economy to concentrate on higher-value activities, improve efficiency, and raise overall living standards. Returning to the claim that trading partners, especially China, stole from the United States, trade benefits both sides. The gains for China are visible because China began from a much lower economic base. The gains for the United States are less obvious, but very real. Consider several channels. First, intermediate goods. Roughly half of U.S. imports consist of intermediate inputs, components, materials, and industrial parts. Cheap imported inputs lower production costs for American businesses, enabling expansion, innovation, and hiring in higher-value sectors. Second, consumer surplus, sometimes called a hidden tax cut. By importing lower-cost electronics, clothing, and household goods, U.S. consumer prices are kept significantly lower, which keeps inflation in check. This disproportionately helps lower and middle-income American families. Because they spend less on basic goods, they have more disposable income to spend on local, American-made services like dining out, healthcare, entertainment, and home improvement, which drives domestic economic growth. Third, direct job creation from U.S. exports. Trade is a two-way street, and China is one of the largest export destinations for the U.S. According to estimates from the U.S.-China Business Council, exports from the United States to China support hundreds of thousands of American jobs, with recent figures around 930,000 jobs tied to combined goods and services exports. These positions are found in sectors where the U.S. has competitive strengths, such as aerospace, agriculture, automotive parts, and semiconductors, and many of them are relatively high-paying, high-quality jobs. Fourth, lower interest rates. The dollars that leave the United States to pay for imports often flow back into the U.S. financial system, where they are invested in assets such as Treasury securities. This helps finance government debt and put downward pressure on interest rates. For the average American, this can translate into lower mortgage rates, reduced credit card interest, and more affordable car loans. Let's return to the mid-1960s, a bit before the U.S. started to run a trade deficit. At that time, the simultaneous funding of the Vietnam War and Great Society programs, often referred to as a guns and butter macroeconomic strategy, led to a massive increase in government expenditure. This fiscal expansion, combined with an accommodative monetary policy, triggered a steady rise in inflation. The Consumer Price Index, which had hovered between 1.1% and 1.6% from 1960 to 1964, escalated to 3.0% by 1966 and reached 5.8% by 1969. Crucially, relatively low trade barriers allowed imports to flow freely, which helped absorb the excess domestic demand. Had imports been hindered during this era, the resulting inflation would have been dangerously higher, especially when we take into account that the unemployment rate was below 4%. In fact, had the United States chosen the protectionist route, history would have been different and likely much worse. But that is a topic for another video. To conclude, living standards rise when people produce higher value products. Protecting factories that manufacture goods we could buy more cheaply from abroad means that we are deceiving ourselves, assigning artificially higher value to cheaper goods. That doesn't raise our living standard. It traps workers in low productivity jobs instead of shifting them into higher value sectors. If we cannot manufacture imported goods as cheaply as other countries, it is usually because our labor is more expensive, which is actually a positive sign, as it reflects our workforce's higher overall productivity and earning potential. A trade deficit cannot be theft by China or Mexico because no single policymaker can fabricate it. A trade deficit is the outcome of a very complex global economic structure and context, too complex for one policymaker to manipulate. Any attempt to manipulate it would end up hurting the party trying to do it the most.